Sandeep Singal, co-head institutional derivatives and equities with Emkay Global Financial Services. Sandeep Singal, good morning. Thank you for joining us. So what are you advising your clients? The fact that we are pitted against some key events in the month of March, are you advising your clients to exercise some caution?
We came out with a strategy report, and what we are seeing is that the economy is contracting. That is very clear. And if you see the expenditure side of GDP, the consumption expenditure, which was growing at about 20 to 24% at one time, have declined to 15.5% this quarter in last 3-4 quarters. So mostly GDP growth has been led by consumption, and there has not been much action on investment side, whether it's private investment or government investment, and also export import contributes very insignificant part into the GDP. So what really is indicating that top line would be affected sooner than later, and most of the top line is already coming at not so profitable growth because of the higher input costs of labor, capital, as well as the material. So that is why we analyze the result of this quarter for all the BSE 500, BSE 200 and Nifty 50 stocks, and what we find that top line is at say 20 to 24% growth, but PAT margins have been affected by about 3%, and ex banking and financial there is about 3 to 4% kind of a PAT growth. So when this kind of an environment is there, and numbers are already on the dashboard that GDP grew by 6.1%. Now that is very evident now that there is a shrinkage, there is contraction in economy now. It's anybody's guess that how much further it can contract actually. Now that is the call one has to take. That is what we are advising. And if someone says that okay, I want to participate on this rally because there is optimism, there is liquidity, well, good enough. But if one really looks at underlying economy instead of price action, then frankly one should be really lightening up the beta position, because underlyings are not really performing that well actually. So that is the sense that we are giving to our clients.
Ashwini, let's bring your thoughts on ONGC, and how do you think the stock would actually shape up this morning?
Well, it will, go back to doing what it was doing earlier, which is, basically range bound 255 to about 290. And I think that is one reason, a lot of people didn't want to participate, because the stock does not move at all. When crude goes lower, it has problems. When it goes up, it has problems. People buy stocks to make money. So chances are it will go back to into its range, and there will be no up or down significant movement worth trading.
Sandeep, what do you think that the ONGC FPO means for other stocks, other companies where Government of India had planned a stake sale or a FPO? Coal India, BEL, BEML, and then SCI.
I think though government delayed their disinvestment program of ONGC BHEL, but now they have started it back. The learning from ONGC stake sale would be that auction method seems to be good because it reduces the cycle, it gives you a good price. But yes, looks like the floor price that was decided could have been much juicier for foreign investors and other investors to get in. There was initially confusion as to whether retail can participate or not. Retail would participate only if there is some money left on the table to make either by way of arbitrage, or you can just buy just below maybe fair value or market price and then make money. So maybe some review of these actions, and my sense is that government would now announce a series of disinvestment programs, but definitely idea should be to bring in long-term investors money into the stocks instead of again money of PSU banks or LIC, GSE, etc.